The response to this initiative has been fantastic, beyond our expectations. I just wanted to give you a sense before we start. More than 1,000 people have signed up, registered from all around the world, including lots of faculty members from the top finance and economics departments. So thanks all for tuning in. So before we start, I just want to go over a couple of housekeeping items. The presenter will speak for the first 15 minutes uninterrupted, followed by a 25-minute Q&A session. Now, if you as an attendee want to ask a question or submit a comment, you could do it in a couple different ways. First off, you could submit a question during the talk using the Q&A feature, and we will monitor that, okay? The Q&A button is at the bottom of your screen. You can also submit any comments that you want to share using the chat. And then finally, if you, at the end of the presentation, want to ask a question, we have the raise hand feature. You can't go like this, okay? You have to use the raise hand feature within Zoom to indicate that you want to ask a question, and then we'll get to you. Now, there's so many people attending that unfortunately we will probably not be able to get to all questions live. We apologize in advance. Don't get too mad at us if that happens. Thanks for your understanding. That said, after the seminar is over, the speaker will have access to all the questions and comments, including those we didn't get to. So you will be heard, at least for the speaker. All right, so that's about it. Without further ado, I am now going to turn it over to our first speaker. We are very happy to have Darrell Duffie here from Stanford University, who will present his paper, The Decline of Too Big to Fail. So Darrell, you have 50 minutes.
Thanks so much, Lars. First of all, I just want to thank you, Lars, Mike, Eric, Valentin, and Mariam for setting this up. It's an amazing opportunity. I was just telling my PhD students yesterday that although it's the effect of this crisis on research interaction within schools is very unfortunate, it does open up possibilities like this for reaching wider audiences with a common research interest. So I'm honored to be doing this. What I want to do is discuss some new research that I'm doing with Antje Berndt at Australia National University and Yichao, also at Australia National University, on what we call the decline of too big to fail. And I need to unpack that. In a few minutes, I'll display my screen and walk through a traditional seminar presentation. But before that, I want to explain the motivation for this work. First of all, how it came about and why we think it's important. Coming out of the last financial crisis, after the crisis abated, we saw a initially very puzzling phenomenon. Regulators and banks, although they had different views on increased capital, they were convinced that banks had a lot more capital buffers than they had before the financial crisis. At the same time, credit spreads for bank unsecured debt were much higher than before the crisis. Now, again, safer, at least in principle, banks, but higher credit spreads. And both effects are very large in magnitude. So how does one square that? There are a number of alternative explanations, which we get asked about, but I'm going to focus on the one that we think is most plausible. We're not ruling out the others, and then we're happy to engage on the others, which I'll discuss. The first explanation that we have in mind is that creditors, unsecured creditors to large banks, after Lehman's failure, really believe that they may actually be forced to take losses the next time a large financial institution approaches insolvency. Whereas before the financial crisis, the data seemed to indicate, and all prior research to that point had indicated, that large financial institutions were protected by their governments, that they wouldn't be allowed to fail, that they were, quote, too big to fail. So I'm going to take you through some numbers that again triggered our interest, and then go through a model that tries to estimate this declining effect of too big to fail expectations by creditors. let me mention briefly, and then we can come back to it, some alternative explanations. One of them, which is prominently advocated by Nicola Gennaioli and Andre Schleifer, is that before the financial crisis, there were implausibly, irrationally low probabilities assigned to the failure of a large financial institution, essentially behavioral explanation that people were asleep at the wheel. And then the financial crisis and the failure of Lehman shocked those subjective probability estimates to much higher levels. An alternative explanation that we're going to try to control for is that other things have changed since the financial crisis, such as increases in default risk premia, increases in losses given default, and other explanations for why bank debt should have such high credit spreads despite much higher capital buffers. By the way, when I say much higher capital buffers, I'm not saying that banks are adequately capitalized. That is, I think they actually, we would all benefit from higher capital levels yet. But I think almost all observers agree that banks are substantially more capitalized now than they were before. Let me start now just giving you, by sharing my screen, giving you an indication of the preliminary look that we had at this that prompted this research. And when we get to the empirical part, I want to emphasize that all of our estimates are preliminary. We've been working on this paper for a couple of years, and we're improving our model. The paper is not yet ready for submission. The numbers will change a little bit before the paper is done, but they're quite robust to changes in model specification, as I'll explain. So first, let's have a look at what happened to wholesale unsecured credit spreads to large banks coming into the financial crisis and then coming out of it. On the left-hand chart is the credit spread in the form of LIBOR minus OIS for 1 year wholesale unsecured bank debt. And as you can see from the chart, leading up to 2008 crisis, those credit spreads were on the order of 10 basis points. And that's not a typo, the figure is correct. Amazingly, and despite what we know about the low degree of capitalization of banks at that point, wholesale unsecured creditors were offering 1 year credit at 10 basis points. Of course, during the financial crisis, that credit spread soared, but after the financial crisis, as you can see in the chart, beginning in 2010 and going forward, there are two notable changes. First, credit spreads are about 5 times higher. And secondly, with changes in market conditions, like the European sovereign debt crisis, credit spreads are actually fluctuating significantly, as opposed to the pre-crisis situation in which credit spreads were basically always small. Our interpretation, pre-crisis, creditors didn't really believe they would be forced to take losses if a bank was approaching insolvency. Post-crisis, they actually were very aware of that and realized that they might be forced to take a loss, either because the bank would fail like Lehman did. Lehman taught them a lesson, or because of new regulations, which I'll discuss, that made it easier for governments to force a bank to go through what's called bail-in, meaning the unsecured creditors take a loss by having their debt claims taken away and being given equity claims in their place, essentially being forced to recapitalize the bank themselves. The right-hand side chart tells roughly the same story using 5-year CDS rates. In the blue are European banks, and in the red are US banks. And of course, 5-year credit spreads are higher than 1-year credit spreads, but the same story comes through. Pre-crisis, very low credit spreads on the order of 30 to 40 basis points. Giant rises during the crisis, and then post-crisis, on average, much higher credit spreads and much greater fluctuation. In this paper, we're actually going to use 5-year CDS rates as our main window on the pricing of unsecured credit to large systemically important banks. This particular diagram has, for US banks, JP Morgan, Citibank, Bank of America, Morgan Stanley, and Goldman Sachs, and and you can see the selection of European banks. The paper that I am presenting to you today is for US systemically important banks only. We are currently working on a similar project for European banks. And we don't necessarily think the decline of too big to fail applies the same way in Europe as it seems to apply in the United States. The data will speak on that, but my hunch, without having looked at our results yet, and looking at the credit spreads of European banks and their capitalization, my hunch is that European too big to fail has not gone away as much as it has in the United States. So now let's try to reconcile these much higher post-crisis credit spreads, which are much more sensitive to market conditions. Here's the US ones again, I'll skip that slide, with changes in bank capitalization. Now, I'm sure you've all heard about the new Basel project by which systemically important financial institutions are now forced to have much larger capital buffers. In this slide, you can see the 2007 and 2015 capital ratios of 6 systemically important US financial institutions. I just picked 2 years that are representative. The numbers will be similar if you look at other pre-crisis years and other post-crisis years. And these are out of financial disclosure. The capital ratios are in the form of tangible equity to tangible assets, which is, I think, a reasonable way to do it if you only have accounting data. We'll get to market data later. And the story is that the red bars are a lot smaller than the blue bars, meaning the banks had much less regular or tangible accounting capital before the crisis and after. Remember again, the contrast with the credit spreads that you saw on the previous slide. Higher capital buffers, but higher credit spreads. How do we reconcile that? That's the story of this paper. Now, if you are concerned that the tangible equity to tangible assets is not incorporating the effects of the volatility of assets, and you might be concerned that asset volatility has grown since the financial crisis, we've taken the opportunity to do a weighted average solvency ratio that normalizes for asset volatility. So what we did is take the same kind of data that were on the previous slide, but for each bank divide by the standard deviation in dollars of changes in asset value over a 1-year period, so that in this slide, you're seeing roughly the number of standard deviations that large financial institutions are away from default in that sense. So their capital buffers in standard deviation terms. And the slide again says, in fact, to an even greater degree, I think more clearly, that capital buffers are substantially larger after the financial crisis than before. And yet we still need to reconcile this with the higher credit spreads. Before we get into the modeling, let me say why I think this is important. First of all, as academics trying to understand the pricing and the risk premia for financial institution debt, it's very hard to do that if we imagine that there's a significant probability that the debt will get bailed out, unless we try to account for the likelihood with which the debt will get bailed out. So for example, if you were to look at a large European financial institution today, and there's a list of household names of large European financial institutions, where concerns have been expressed, if you were to look at their credit spreads and say, well, that bank is able to issue 5-year debt at 150 basis points over risk-free, they must be reasonably safe. You might then ask yourself, well, wait a minute, maybe it's only 150 basis points over because creditors believe there's a likelihood they're going to get bailed out that's pretty high. So you need to incorporate that into an asset pricing model in order to determine something about those default likelihoods. And of course, if you were a regulator in Europe, similarly, if you're trying to use market price discovery as a source of regulatory monitoring, which I think is not a bad idea, then you would want to try to correct for the fact that wholesale creditors think that they're going to get bailed out. Before I get into the modeling, I want to criticize what we have accomplished in two very important respects. And these, I think it's going to be very difficult to overcome these two problems with the data available, but I want to give you truth in advertising about the limitations of our study. First, we are actually unable to tell you the estimated default probabilities before and after the financial crisis. Those two numbers are impossible to separately identify. Why? Well, if you scale up the likelihood that a bank won't get bailed out by the government by some multiple, say by a factor of 1.1, it's exactly the same from the viewpoint of observable market information as scaling up the expected losses given default for a failed institution. Let me repeat that. LGD, if scaled up by a given factor, has the same impact on credit spreads and on bank equity prices as scaling up the likelihood that the government won't bail out the bank by the same multiple. And it's very difficult to pin a number on LGD for large financial institutions' failures. We have one observation, that's Lehman. And it was anybody's guess going into Lehman's failure what that number would be. It was actually 10% on the month of Lehman's failure. And since recovery has risen to 50%. And if you were to try to estimate what it is for another large financial institution's failure, I think you would be hard pressed to do that. So that's one major weakness of our analysis. The second major weakness is that we can't tell you the actual probabilities of government bailout. We can only tell you the risk neutral probabilities of government bailout. Why is that? Well, we only have, again, only one systemically important financial institution in recent history has actually failed and not gotten bailed out by the government. That's Lehman. It's pretty hard to form a statistical estimate based on one observation. So what are we going to do about these problems, these two problems that I just raised? Well, with respect to the first, that is, we can't empirically disentangle expected losses given default from expected bailout probabilities. What we can offer is the following. You give us your probability estimate for one bailout probability post-crisis, and we will tell you what the data say, given that it is pre-crisis. In other words, we can give you a schedule of data-consistent pre-crisis and post-crisis bailout probabilities. And about the second problem with respect to not having actual bailout probabilities, we can only give you risk neutral or so-called market implied bailout probabilities. That is, embedding the effect of risk premia for these bailout probabilities. I'm actually going to ask Valentin if he wouldn't mind at some point, whenever it's convenient for him, to conduct a little poll of everybody listening on not your risk neutral, but your actual subjective probability assessments that going forward, large US financial institution would be bailed out by the US government. Valentin, would you mind running that poll?
Yes, so it should be on for everybody. There's a link at the top of the window that you should go in any navigator or on your phone, and you will see a web page appear, and you should be able to vote or to pronounce your opinion on this question.
Cool, I can see the poll in real time. We can use these data in the next version of our paper to suggest what a sophisticated audience of financial economists think about these likelihoods. I suppose these are going to converge at some point. I'm going to wait for another minute. While I do that, I'm going to note that in a minute, Valentin is going to ask the same question for European systemically important financial institutions. I'm interested in that for two reasons. Number one, I think it's probably different than that for the US. And number two, as I mentioned, we're going to conduct a similar study. We're in the course of conducting a similar study for European systemically important financial institutions. And I understand that for Europe, there's a lot more heterogeneity because you have multiple governments that can influence the outcome. So let's say the Italian government may have a different view on this than the French government. As we know, in Italy, Monte dei Paschi was bailed out by the Italian government already, and that did change market pricing of bailout probabilities. So this number is, the polled number is putting a lot more weight on 80% than I had expected. Some are saying 100%. That's very interesting. By the way, that 80% and 100% weights those are going to be, if they were risk neutral probabilities, they would be very hard to reconcile with the data that we're seeing, as I'll explain. But there is the effect of risk premia, so we can be saved by that. Valentin, in the interest of time, could we march ahead to the European one? I see somebody very quick with the fingers on that one. Wow. So 100% is getting more weight than the case of the US. But 80% is also getting lots of weight. So is 60%, 40%. I'm guessing that when this is done, the probabilities for Europe that you're assigning are actually not a lot higher than on average than the ones for the US. And as I said, that's not my subjective probability, but it's completely consistent because it's hard to tell what these numbers are. But subjective probabilities will be very informative to us. So thank you for doing this. I'll just let this stay open for a short remaining time. By the way, the Financial Stability Board, which is the International College of Financial Regulators, is in the course of conducting a study on whether or not too big to fail has declined for systemically important financial institutions globally. Okay, so I suggest we move forward. One weakness of this poll is that everybody gets to see everybody's previous answers before they put in their own. So there could be some herding effects, but let's just see. Let's just see. So I'm going now back to the approach that we're taking. I mentioned earlier that regulators have perhaps contributed to the decline of too big to fail that we're seeing in our data with new rules, new laws and implementing rules that allow regulators to shift expected insolvency losses from taxpayers through bailouts to the wholesale creditors with a technique known as bail-in, which, as I said, swaps debt claims for equity claims and forces wholesale creditors to take those losses. In any case, whatever the cause, we are estimating significantly reduced market implied probabilities of bailout in the United States post-crisis. And we're estimating corresponding increases in credit spreads for a given degree of solvency.
Hey,
that is,
Darrell, could you share your screen?
Oh.
Thank you.
Yeah, thank you. Okay, I'm back. Let me explain this slide again. I'm sorry I stepped out for screen share. Three bullet points in this slide, two of which I mentioned. First, there are new regulations that promote the results that we're seeing through the ability of governments to force losses onto creditors rather than taxpayers. Secondly, main empirical finding, significant reductions in market implied probabilities of bailout post-crisis. Third bullet point, which is our second main finding, at a given solvency buffer, credit spreads are now much higher. And in fact, they're around double what they would be with pre-crisis bailout probabilities. So what you're seeing now in terms of credit spreads, according to our model, are roughly twice as high credit spreads as they would be if creditors still expected the same government support that they had before the crisis. And those expectations flow into the prices of bank equities. Why? Well, because the bank equity benefits from the subsidies supplied through the credit spreads. When banks can borrow much more cheaply because of bailout expectations, they can blow up their balance sheets fueled by cheap debt financing and blow up the price of equity. So the government was implicitly subsidizing equity claims and still is, but was doing it a lot more before the crisis than afterwards. This also induces leverage, but I'm not going to talk about that today. What do the credit rating agencies say about bailout expectations? Well, to give you a comparison, I plotted here Moody's ratings at the median in blue for all US corporations that are rated. And you can see there's a little dip after the financial crisis, but more or less it's reasonably flat. And in red for US globally systemically important banks. And you can see that post-crisis, globally systemically important banks have a much smaller credit rating, consistent with the higher credit spreads. Now, what accounts for those reductions in credit ratings? The rating agencies actually are explicit about that. They say explicitly how much of the credit rating in notches is due to explicit government uplift. That's what it's called, uplift. And so most of those notches that were lost in the post-crisis are explicitly associated with the rating agencies removing notches for government uplift of ratings. So the rating agencies seem to agree that there has been a significant decline of too big to fail. What about prior work on this problem? Well, before the financial crisis, there was the 2008 financial crisis, there was already a lot of work showing that too big to fail was present in the prices of bank equities. And basically it was doing that by comparing large bank equities to small bank equities and using a lot of other sources of information to draw that conclusion. Post-crisis, I would say our work is preceded by three important studies that address the same problem that we're addressing. I'm only highlighting these three. So one paper by Acharya, Anganer, and Warburton, using a panel approach, not entirely unlike what we're doing here, finds that there was no significant change in bailout expectations associated with the passage of the Dodd-Frank Act. Now, they did this, this was a 60-day event study. So the fact that they don't find changes in bailout expectations, and we do, could be associated with the fact that an event study of 60 days did not incorporate all the information about the likelihood of that, of what was going to be in the Dodd-Frank Act on bail-ins, and of course the event that Lehman was allowed to fail, contrary to my expectations. I remember when a hedge fund guy called me from London on the weekend of Lehman's failure and asked me, what do you think, will the government allow Lehman to fail? I said, probably not. And I think I was among many people that believed that that would make a giant crater on the US economy and the government would avoid it. It did make a giant crater on the US economy, but the government did not avoid it. And there's a lot of controversy still about that decision. But anyway, I think it was a surprise for a lot of people and it did change expectations. Second study uses CDS data and exploits the fact that in 2014, there was a change in the CDS contract that ensured buyers of protection against bail-in. And from the difference between the 2014 vintage contracts and the earlier contracts that did not have that feature, which were still trading, these authors, Neuberg, Glasserman, Kay, and Rajan, were able to suss out significant implied changes in the expectation of bail-ins. That is, that governments would reduce government support. However, when Monte dei Paschi was bailed out in 2016, that pricing effects went away in the CDS market, and in Europe, these are only applying to Europe. A bailout seemed to become a higher expectation. And then in a study by Atkinson, Davernat, Eisfeld, and Vey, these authors constructed a composite US bank. That is, all banks, small and large, for the US were put onto a single balance sheet and income statement and modeled as one bank going forward. And the authors calibrated that bank to market data and estimated a post-crisis 23% decline in market-to-book ratios associated with reductions in bailout subsidies. The data that you're going to see in a few minutes suggest the same general order of magnitude of reduced market-to-book ratios associated with bailout subsidies. Let me give you an idea of the model. I'm not going to take you all the way through it in the interest of time. And then summarize the results, and then we're going to have time for Q&A. It's a bit unlike a seminar, I must say, in that we're not getting live Q&A during the presentation. I hope you're not getting tired of listening to my voice. I'll try to keep it lively as we go forward. So here's the image that you should have in your mind of the balance sheet of a large financial institution at the point at which it's about to either go into bankruptcy and fail or get bailed out by the government. And that point of insolvency is when the assets of the bank, shown in red, drop to some trigger level called B star. And the spirit of the model is that of Leland 1994, jazzed up to incorporate various other features that we need to talk about. On the liability side, we have bonds and deposits, and these are shown in blue and green correspondingly. Here's what happens at a bailout. If the government bails out the bank, the way we're modeling that is that the government injects enough bailout capital to make the new total assets rise to a level that's sufficient to cover the liabilities at a normal level, which is basically to price the debt at par with a typical steady state sort of bank credit spread. There is an alternative outcome, which is rather than getting bailed out, the bank goes through bankruptcy. The assets suffer a distress cost, which is a typical way to approach this. They only recover some fraction of the original asset values. The bonds take a big haircut, and depositors get bailed out even if there's not enough assets to cover deposits. So in this model, we are going to include guaranteed deposits whether or not the debt is bailed out. And that's, I think, an important feature to allow for, both in regulation and in expectations. I think everybody believes that depositors are going to get bailed out, and if there is a loss, it'll get taken by the unsecured creditors. These respective probabilities for bailout and no bailout are, in this model, only risk neutral or market implied. And I already apologize for the fact that we cannot identify statistical or actual probabilities of bailout from the available data. There is an alternative to bankruptcy, which is called bail-in. So in the event of not getting bailed out, it's possible that the bank will either go through bankruptcy or get bailed in. And we don't try to deal with that distinction because, as you can see from the two balance sheets that result from bankruptcy and bail-in, the bonds take a huge hit and the depositors are safe and the equity gets wiped out in both cases. So it's pretty much impossible to identify the relative probabilities of bankruptcy versus bail-in. With the available data, we cannot distinguish between the two. So we're just going to lump that into not getting bailed out. Going back to the bail-in picture, the bailout picture, we need to account for the fact that once the creditors are bailed out and the bank continues, they could still lose going forward at the next opportunity for the bank to go insolvent. That is, there's a continuation problem and it becomes recursive. And we account for that in our model. We actually include in our initial market values for debt and equity the event of bailout with a subsequent continuation and a possible future bankruptcy, and so on and so on and so on, until the bonds mature and until everything is done, so that the model is consistent with the continuation values of the financial instruments, which is pretty important as it turns out in the data. It turns out, just to give you an idea, that of all the bailout subsidies going to equity and to debt, about 2/3 of them are associated with the first bailout and 1/3 associated with any subsequent bailouts. So we can't really ignore the continuation effects of future bailouts. That's a pretty big factor. Okay, very briefly, only one slide on the model, because we need to get to the data and finish up in the next 12 minutes by my look at the clock. Is that right, Lars? Got about 12 minutes before we move over? Good, okay. So first, the model of the bank's assets. It's traditional, except in a couple of respects. One is the Brownian motion driving changes in assets is now replaced with a general Martingale-Levy process, which can include jumps, both Brownian part and jump part. And the reason for that is, first of all, jumps I think are pretty important. As we saw in the last few weeks, bank equity dropped. I noticed one day, 3 weeks ago, Citibank dropped 20% on one day. Bank of America dropped, Citibank dropped 17%, Bank of America dropped 19% on the same day. So drops, sudden drops are important. The second thing is that we don't require that, as in the Leland model, we don't require that the value of the assets in place is the present value of all future cash flows going to the assets, net of distress, because banks are oligopolistic. They make extra rents and have other costs like overhead that mean that when the bank buys an asset for $100, it may be actually making more than $0 in profit from that purchase. And in the Leland model, it's hard to do that. So we allow for extra rents or other costs to the bank for running the bank. You don't have to have that, but it's allowed for. We also changed the Leland model by allowing guaranteed deposits. And we also changed the Leland model by not forcing the deposits, even though risk-free, to have a risk-free interest rate, because we all know that large banks get a lot of funding at below market interest rate deposit interest rates. And so that's important when you're trying to calibrate a bank balance sheet and income statement, or a balance sheet and equity price, to account for that cheap financing from deposit funding. The bond maturity structure is a standard Leland approach. Bonds have an exponential maturity with some average maturity that's calibrated, some coupon rate, and some total amount of principal. And as bonds mature, the bank refinances the principal paydown by issuing new bonds at new market prices. So that's a kind of clever feature of the one of the papers by Hein Leland in the mid-90s that we're exploiting. How do we solve the model? Well, there's a lot of equations that are in the appendix of the paper, but basically we add up all the cash flows that are coming in. We add up all the claims on those cash flows, and we equate the two. The residual variable is the value of equity. That allows us to get a formula, analytic formula for the value of equity. And we use the smooth fit condition to establish the default boundary at that level of assets at which the equity price drops to zero and the equity owners will give it up. We then just stipulate that the government will inject a given amount of capital, enough to bring the bonds up to a par credit spread. It's very, very simplified. But we're not fitting directly off of this model. We're using this model in a way that I'm now going to explain. I'm going to skip that slide in the interest of time. It talks about the subsidies. I'm going to talk about our data and then the solution. The data are for US globally systemically important banks, and which are listed on this slide, and for domestically systemically important banks. Those are the publicly listed large banks that are not classified by regulators as GSIBs. And they're listed in the paper and on this slide. And we treat them as separately. And as you'll see, the results are different for GSIBs, which are more too big to fail, than DSIBs, which are too big to fail, but not as too big to fail. Here's the fitting strategy. I'm going to go through this slide slower because this is the guts of the actual fit, which is a combination of reduced form and structural. So first, on the very first line of the slide, note that the credit spread can be viewed as roughly equal to the probability annualized of failure or of approaching insolvency times the loss given insolvency times the probability of not getting bailed out. That's 1 minus pi. So this is a standard, P times LGD spread, except that the LGD includes a factor associated with not getting bailed out. If you do that in logs, you get log of credit spread normalized by the no bailout probability is equal to the log of the annual risk neutral default probability plus the log of the loss given default. Now in prior works, Antje, one of my co-authors, and I, and 2 other authors, showed there's a very good fit for the log of annualized risk neutral default probabilities from what's called distance to default, which is a variant of the standard Merton distance to default measure. The tricky thing here is that how far you are from default depends on your assumption about bailout probability. So we can't just plug this into a standard linear regression model. Rather, as you see on the very last display on this slide, we're going to do this regression as a panel regression, except we can't fit it linearly because you can see that the probability of a bailout pi enters non-linearly throughout this equation. So what we do is we fit this by nonlinear least squares using an iterative method, which is basically pick a pi, estimate the model as a linear panel, and then change pi until you minimize the sum of squared errors. That's cutting through a lot of fitting without giving you much detail, but in the interest of time, let me just leave it right there. And our objective, again, is to find out what is pi. What is the number pi that fits this panel best? These pi's are allowed to depend on what is the bank, that is, whether the firm is a bank. We include non-banks because we need to get the default risk premium relationship. So for non-banks, we assume the bailout probability is 0. And for banks, we have a pre-crisis number and a post-crisis number. And we have one for GSIBs, the globally ones, the global systemically important banks, and one for DSIBs. So we've got 4 different pi numbers to estimate because we only allow pi to vary pre-crisis versus post-crisis. Okay, that was very, very brief. And now I have time to tell you what the results say. So here is the headline numbers. Conditional on the insolvency of a large bank, we estimate a significant reduction in market implied probabilities of bailout. So let's pick the numbers in blue just to go through this. As I said, we can only give you a schedule of data consistent pairs of pre and post-crisis bailout probabilities. So in blue, for a globally systemically important bank, 0.65 pre-crisis bailout probability is consistent with a post-crisis bailout probability of 0.2. Now, I know from our poll a little while ago that most of you thought that the post-crisis, meaning from here going forward, is much higher than 0.2. So for most of you, you were assuming essentially 100% to be data consistent. And if your numbers were risk neutral, not actual, you would be assuming essentially 100% pre-crisis bailout probability. In any case, these are the data consistent pairs for GSIBs and for domestically systemically important banks. However you look at it, the numbers show a dramatic reduction in market implied bailout probabilities. I'm going to skip this slide and talk about the implications for credit spreads. And then I'm going to finish off and we'll go to Q&A. So what this chart, this is the last chart I'm going to show in the interest of time, shows by time, it shows the fitted 5-year credit spread on unsecured debt for a hypothetical US globally systemically important bank that's always 2 standard deviations from default. Its distance to default is 2. So this bank has constant credit quality. And yet there's a significant change in its credit spread from pre-crisis to post-crisis. How did that happen? Well, because post-crisis, this bank that's always the same, has always the same capital buffer in risk-adjusted terms. Post-crisis is assumed to have a much lower likelihood of getting bailed out by the government. And to give you a counterfactual, in the red dashed line, you can see what that credit spread would have been had bailout probabilities remained at the high pre-crisis level. They would have been about half in the years after the financial crisis of what they actually were. So banks are paying a lot more for funding now, about twice as much for 5-year funding than they would have paid had the government continued its old policy of, the assumed old policy of bailing out these financial institutions with very high probability. The implications of that are, now that banks have much higher funding costs, they are much less likely to blow up their balance sheets with cheap financing and much less likely to fail. So this is a good development from the viewpoint of financial stability. Of course, bank shareholders don't like it because they're not getting giant subsidies. And the subsidies are on the order of about, pre-crisis, about 30% on average of equity market to book ratios were associated with bailout subsidies. There's more information in the paper and on the slides about those equity subsidies, but they're very important. Okay, so we hit 10:20, and I have a contract with Mike, Lars, Eric, and Valentin to pass it back to them at this point. So thank you very much.
Thank you very much, Darrell, for a great presentation. So we're going to move into the Q&A part of the session. I'm going to start, basically I'm going to call on some people that have expressed an interest or have given some questions already, and then we'll unmute you and you can ask your question live. If you are interested in asking a question, at this point, it would be good if you use the raise hand feature, okay? The first question is going to be from Natasha Saren. So if she can be unmuted, we can start with her. Go ahead, Natasha.
Can you hear me?
Yes.
Yeah.
Oh, hi, Darrell. Thanks for this. I was just wondering what you thought or how you think we should think about sort of preferred stock, because post-crisis, the world looks sort of identical to what it did pre-crisis. And this sort of can't have anything to do with the disappearance of too big to fail. So I wonder if you think there's other things happening, like a decline in franchise value, for example.
Yeah, I read your paper with Larry Summers, for those of you that don't know their paper. So I had discussions about it with Larry. So first of all, I think your paper with Larry is correct on the fact that bank franchise values have gone way down. Part of that is, of course, they don't have the cheap financing that I just discussed, but it's also the case that net interest margins are way down, in part because the central banks have kept rates very low. And a lot of banks are still climbing out, like Deutsche Bank, for example, and SocGen to some extent, are still climbing out of very deep structural problems, IT, mismanagement, misbehavior, legal claims, and all kinds of other bad things going on in their balance sheet, including, in recent news, some very intractable assets. So I do think that you hit the nail on the head when you say that franchise values are much lower now than they were pre-crisis, in part for the reasons I mentioned and in part for these other reasons. That said, I don't think that the very high credit spreads that we're seeing are associated in the US. I'm only restricting attention to the US for now. That the high US credit spreads are associated with significant fears of insolvency, or at least for our data set. Now, we just hit one of probably the worst macroeconomic shocks since the Great Depression. And I noticed this week that Citibank's CDS rate for 5 years is 120 basis points. And I'm very interested myself in how much of that 120 bips is associated with bailout, meaning would it be a lot higher were it not for bailout expectations, and how much is associated with the fact that Citibank is now going to be looking at a lot of NPLs and much lower net interest margins with US having hit the zero lower bound on interest rates. So you asked a really good question. I think the best way to answer it is to wait for 5 more years and do another study about what this crisis did.
Okay. Thank you. We're going to go to the next question here. We got a question from Mayar Kargar from Champagne, Urbana-Champaign. Mayar?
Yes, thank you, Darrell, for the great presentation. So the question that I have is that if you look at the flow of fund holdings of corporate bonds by dealers, you see a dramatic decline from the pre-crisis. So obviously some of it is due to the basic disappearance of non-agency MBS, but I'm just wondering, is the higher financing cost due to this higher credit spreads post-crisis would be an explanation why it's harder to finance inventories for dealers?
Yeah, I think you hit the nail on the head. And there's lots of evidence that not just in the corporate bond market, but also in the interest rate swap market and in the government securities markets, the banks are not interested in holding a lot of these assets on their balance sheet because of the funding costs and also because of higher capital requirements. I actually wrote a paper on this with Leif Anderson and Young Song called Funding Value Adjustments that shows that when you raise bank credit spreads, you're essentially, by a given number of basis points, you're essentially raising the cost of intermediation by exactly the same number of basis points. So bank credit spreads go up 100 basis points due to a reduction in too big to fail. Then the cost of holding assets on your balance sheet to equity shareholders go up by 100 basis points according to theory. By the way, that's much less than the banks themselves complained about, but they actually account for those extra funding costs now with what they call funding value adjustments. So you're dead on right, and I think that's what explains much lower bank bond inventories.
All right, thank you. The next question is from Marcin Kaspachik from Imperial College. Can we get him unmuted? Here it is.
Hi, Darrell.
Hi, Marcin.
How are you? Great presentation. So I had a small comment, which is I was curious how these pictures look like for the small banks, but maybe since I have a voice, I have a slightly different question for you, which is, in some sense, does it matter what's the source of the problems that the banks face? Like if you think about the crisis, what was happening there was basically, there was a notion that banks basically mismanaged whatever they were doing. Whereas if you take this situation, say to right now, we want to think of banks as some kind of intermediation channel that can potentially save the real economy. So I wonder to what extent that probability in some sense is gonna depend also on what the regulator perceives as to be a source of a problem.
So I think there's a very good point there. For example, with respect to Mayar's question, which you just asked, it doesn't matter why credit spreads are a lot higher with respect to the incentive for banks to provide intermediation. The funding costs are proportionate to the credit spreads for whatever the reason that the credit spreads have gone up. However, it might well matter quite a lot to a large unsecured creditor. They really want to understand what they should be asking for in terms of market pricing, what yields they should get in light of the likelihood they'll get bailed out. And it obviously matters to government regulators when they're looking at a given credit spread. Let's say a large European bank has got a CDS spread of 200 basis points. Do they think, well, that's kind of high right now, but it's not terrible. Maybe these banks are fine. And then they read about, oh yeah, it could be that it's only 200 bips because all the creditors think we're going to bail them out. Maybe the regulator is saying we're not going to bail them out, but what really matters is what they're inferring from creditor expectations embedded in prices. So I think it really matters the source of the increase in credit spread matters depending on what question you're asking. It's a great question.
All right, thank you. So next one is Gustavo Schwenkler.
Yeah, hi, Darrell. Great presentation. I had a quick question just about kind of the statistics of this. Do you take into account kind of correlation between the shocks driving the asset values? Because I have a sense that the way you're estimating this is kind of bank by bank. Is that correct?
We've done it both bank by bank, and we've also done it by treating all of the banks the same. And by the way, Goldman Sachs and Morgan Stanley are completely different from the other large GSIBs in the United States. So doing it bank by bank actually does make a difference.
Yeah, no, I can see that. I can definitely see that because I'm kind of thinking that something needs to kind of rationalize the increase in the spreads that you're seeing. And maybe one way could be that just investors became kind of aware of there being kind of correlations in these shocks that previously were not really incorporated. I don't know if that's possible to kind of take into account into the model that you're considering.
It's a great question. So the correlation, and when you say between, I guess you mean between the various large banks. One thing that we did do, because we were concerned, maybe the reason that the credit spreads have gone way up since the crisis is that in general, default risk premia have gone up since the crisis. And I'm going to go to screen share just to show the same slide that I showed a moment ago. That red line post-crisis even the red line, which is based on the same bailout probabilities for the same quality of bank, is much higher than pre-crisis, meaning indeed, default risk premia are much higher now, by, let's say, a third than pre-crisis. And so accounting for changes in default risk premia of the sort that you mentioned is really important. What we did not do is try to look at changes in covariances or risk neutral covariances between the different large banks. And that's an interesting idea. We might pursue that. I don't have any reason to believe, by the way, that it's gone up or another reason to believe that it's gone down. I just don't know.
Great. So next question, Christian Juilliard from LSE.
Okay, the question is quite simple. Is there an aggregate state variable in the linear least square? Because my worry is that the scope for fiscal policy or monetary policies is substantially reduced. And if there is the case, if there is no aggregate variable, the only way in which that can be picked up in the estimates is by changing actually the agent, the bank specific probabilities.
I'm not sure what you said, but I think what you said or what you asked is whether there's some general macroeconomic change in conditions that might play a significant role. And that's related to the same point that I made a moment ago, which is that we did control for general changes in default risk and default risk premium by including in our data set 700 non-bank publicly traded firms, their balance sheet data, equity price data, and credit default swap data to try to control for general changes in macroeconomic conditions that would influence default risk premia for a given balance sheet. We could try to go beyond that by controlling with other macroeconomic variables, but that's what we've done so far.
All right. Next one is Adrian Dabernat. Let's see, unmute. Adrian? Let's try one more.
I see his co-author, Andrea, is also.
Oh, there he is. Okay, Adrian, you're ready. Maybe not quite ready. Okay, so we'll move to the next one then.
Is the sound not working?
Oh, yes. Oh, now we hear you.
Hi, Adriel.
Okay, perfect. Hello. Thanks a lot for doing that. It's quite fantastic to be able to attend the seminar while being in Stockholm. So me and Andy last year did a very small back of the envelope calculation while looking at your paper. And from looking at your neighbor, it seemed that the average risk neutral probability of default as estimated by your paper was about 2.5%. I mean, that was a rough number that we found doing this small back of the envelope calculation. Well, this is a little bit low if you look, for example, at option prices and the risk neutral probability implied by option price on banks. And if you actually have a probability of default of 5%, the quantitative implication of the model, I think, would be a little bit different. If you had to conclude, I think with 5%, you would conclude that if the probability of bailout was about 60%, then the drop would be much more smaller. It would drop about 53% post-crisis. I don't know if you looked at that.
Okay, so let me go back to screen share. Yeah, I got a note from Andy about that question that you asked. So I'm going to go back to our specification on this slide. So you can see on the top of the slide that we can observe, pardon me, we can observe the credit spreads. But what we can't observe are how to decompose them in the right-hand side variable, which is the product of a risk neutral default probability, which you just mentioned, a loss given default, and a no bailout probability. All we can do is look at variation across time, pre-crisis versus post-crisis, big bank versus other corporations, and get at the changes that are implied by being a big bank or not and being pre-crisis versus post-crisis. We are, however, guaranteed to have whatever risk neutral probability of default we have, it's got to be consistent with the loss given default and no bailout probability. So if you move one of those up, like you just suggested, you've got to move the others down in combination. And that's why we can only give you a schedule of data consistent pre-crisis and post-crisis bailout probabilities. So in answer to your question, yeah, we are respecting market implied risk neutral probabilities in our credit spreads, but only to the extent that we know these bailout probabilities and LGDs. And if we rescale one, then we have to rescale the others accordingly. So that's why we can't pin down any particular number. We can only tell you if you're willing to say that now the bailout probability is 0.2, then before the crisis, it must have been about 0.65. By the way, we've tried a lot of variations in this model, with and without jumps, with and without these oligopolistic rents that I mentioned, different fitting methods. And we do get variation in these numbers, like that number 0.65, it's varied all the way between 0.6 and 0.67, depending on how we fit the data. And so the model error is much bigger than the standard errors for a given model, which we show in the paper. But it's really hard to shake the fact that the pre-crisis probabilities are way, way bigger than the post-crisis one, and that's the main message of the paper.
Great. Next question is from Artem Nekliudov. Artem.
Yes, hello. Hello, Darrell, do you hear me?
Yes, Artem, it's good to speak with you.
Fantastic to.
Now we don't hear you.
Once again?
Okay, there you are.
Yeah. So in your motivation, you mentioned how the volatility in credit spreads increased. And I wanted, so if you could elaborate a little bit how the mechanism of your model generates this higher volatility in the post-crisis period. So my understanding is that in the model, you just estimate the single post-crisis probability of bailout number, right? Correct me if I'm wrong. And so what do you think, when I look in the data and I see this higher volatility in the post-crisis period, how much is it maybe generated by some stochastic movements in these estimates of this bailout probability? How many times investors reassess this probability conditional on being post-crisis?
Right, great question. So first, there are two effects going on here with respect to volatility. One is a scaling effect. So if you rescale those pre-crisis numbers shown, oh, I'm going to do screen share so that you can see this again. Screen share feature is great. So here are 5-year GSIB credit spreads on average for Goldman Sachs, Morgan Stanley, Citibank, Bank of America, JP Morgan, and Wells Fargo. This is not model implied. This is just actual data. So consistent with your comment just now, Artem, post-crisis credit spreads are way more volatile than pre-crisis. Part of that is simply, in our view, reduced expectations of bailouts, which means when there's a change in market conditions, our creditors are saying, uh-oh, I better reprice the credit because I'm not going to get bailed out as much with as much likelihood. And if you scaled up the pre-crisis numbers sufficiently, you probably see proportionate volatility that's not enormously smaller than post-crisis in proportionate terms. The other effect is probably that there is more volatility post-crisis, even in asset values than pre-crisis. And I'm not sure why that's true, but we have accounted for it. We have not, when fitting our model, assumed the same volatility number throughout the data. In fact, we've committed a major modeling error, which is every day when we fit a given number for the firm's balance sheet, market values of the firm's balance sheet, we re-estimate the volatility, ignoring the fact that when we estimated it in the previous period, we assumed that that volatility was constant. Again, that's time inconsistent econometrics. It's not unusual in this literature. And it has the fault that that we have irrational expectations about constant volatility, whereas we fit with time varying volatility, but it has the benefit of trying to capture the point that you just made. Market conditions are not the same. And so we wanted to allow for that.
Great, thank you.
Thank you.
All right, so next up, I want to give the floor to Amiyatosh Purnanandam.
Amiyatosh is a former collaborator of mine on default insurance for banks. So this work continues the line of our common interest in default for large banks.
Go ahead, Amiyatosh.
Can you hear me?
Yes.
Yeah, so Darrell, my question is a little bit about, just wanted to hear your thoughts on learning a story of this kind, that post-Glass-Steagall Act, banks have started taking a lot of new risks, trading income, off-balance sheet items, securitization income. And there was a window of about 6-7 years before the Lehman failed when all these risks were building up, a lot of them hidden in off-balance sheet. Now, and perhaps market did not really appreciate how risky these banks are till the time Lehman failed. And after the failure of Lehman, the banks and the markets understood that they are truly way more riskier than what looked on their balance sheet. So the quality of accounting information, the learning, perhaps has a role to play. Just wanted to hear your thoughts on that. Thank you.
Yeah, there's a very good point there, and it's not exactly the same as Genaioli Schleifer, but it's similarly motivated, which is that in principle, the data were in plain sight that these banks were taking enormous risks, and yet people were not paying enough attention to that because they weren't digging into the details, and we had a financial crisis that revealed all the nasty things that were going on. So some of that failure of looking at things that were available in plain sight, and I wrote a paper about this on the failure of regulators in particular to look at what was in plain sight. Some of that must be accounting for the pre-crisis low credit spreads, and we've lumped it all into bailout expectations, and that's probably inappropriate. Having said that, it was not a secret before the financial crisis that large financial institutions were considered to be subjects of bailout by the government. That there was a lot of research. We cite about 20 papers in our paper that all said, look, these big banks are really risky, but they're getting very cheap credit relative to small banks that are not doing all these complex things that you said and don't have such enormous leverage. There's something wrong with the pricing. The only reasonable story for that is that the big banks are viewed as too big to fail. So I think it could be in part what you're discussing, and I think it's also in significant part what we're talking about, which is too big to fail presumed before the crisis, and is still there, but not as heavily presumed by creditors, at least. I know a lot of you still assign, looked at the poll we took, a lot of you still assign very high probabilities of government bailout. And all we can do in this paper is do risk neutral creditor implied probabilities. So a great question, and I think there's a lot of merit to it.
All right, I think we have time for one last question. This is from Destan Kirimhan. All right, Destan.
Oh, hi. Hi, it's a really great opportunity to be to listen to your great presentation, and I would like to ask like a one step further question. Probably, I know your main analysis is important for too big to fail, but do you think there is like an implication for too many to fail, like a herding or like the interconnection, so too interconnected to fail? So do you think there is like an implication for these, or the model also maybe takes into account these two additional features that the big banks may have? Thank you.
I think that's a great question, Destan. And there's I see two different versions of too many to fail. One is, as in the case of Monte dei Paschi di Siena, governments will always bail out a financial institution for political reasons when their debt is held by retail, many retail investors. I shouldn't say always, but with very high likelihood. And the other one is too many big banks to let fail. And that applied during the last financial crisis, although Lehman was allowed to fail. And I think during the current stress that we're seeing, including builds up a stress in the European context, there is going to be a tendency of governments to bail out large financial institutions when the government believes that many of them, or at least multiple large financial institutions, could fail around the same time and plunge the economy into a deep recession or depression. And so ideally, the kind of work we're doing here should account for, and does not account for, the distinction between bailing out banks one at a time when they individually get into trouble versus bailing out multiple banks when they get into trouble, common trouble in a broad, deep financial crisis. And and that's related to the covariance question that was asked earlier. That was Gustavo's question. There is going to be a covariance effect on bailout probabilities, and it's a great problem for future research. So thank you for the question.
All right, I think that concludes our session today. Thank you so much, Darrell, for being our inaugural speaker. It was a great presentation. Next week is, from now on, the seminars will be on Fridays. Okay, so next seminar is Ralph Cohen, Friday the 17th, okay? So thanks everybody for tuning in. Thanks for asking questions, and thank you again, Darrell.
Thanks, Lars, Valentin, Eric, and Mike, and Mariam in absence. Thank you.